The US dollar once stood as the rock of the global economy, stable, powerful, and trusted. But under Donald Trump's second term, that foundation is cracking. From tariff chaos to shaken investor confidence, the dollar is facing a serious credibility crisis. How bad is it? Let's break it down. In the first 100 days of Trump's second term, the US dollar has fallen nearly 10%. That's not a minor dip, it's the steepest drop in years, with the dollar index reaching a 3-year low. Even more alarming is the fact that US bond yields are rising at the same time, a reversal of normal economic patterns. Usually when markets panic, investors rush to the safety of dollars and US treasuries. But this time, they're fleeing both. Analysts say the dollar's fall began accelerating right after Trump's Liberation Day tariffs, which sent shockwaves across global markets. Investors sold off US assets, including treasuries, stocks, and the dollar itself. More than $5 trillion was wiped off US share values within days. Instead of being the world's safe haven, the dollar suddenly looked vulnerable, and that changed everything. But the real trigger? It all started on a single day. On April 2nd, 2025, Trump unveiled a sweeping list of new tariffs targeting dozens of countries. He called it Liberation Day, claiming it would restore fairness in trade. But markets didn't see fairness. They saw chaos. The dollar lost over 1% in a single day. For investors, this wasn't just policy, it was panic. The dollar, once a symbol of stability, became a source of risk. Treasury bond yields spiked to levels not seen since 1982, and stock markets tumbled. Trump later paused most tariffs for 90 days, but the damage was already done. Deutsche Bank's George Saravelos put it bluntly, "The market is undergoing a process of rapid de-dollarization." And if markets were shaken, investors were about to bolt. Stanford economists Arvind Krishnamurthy and Hanno Lustig have tracked how investor behavior shifted dramatically after April 2nd. In past crises, like in 2008 or 2020, investors ran toward the dollar. This time, they ran away from it. European investors who once paid a premium to hold US treasuries are now demanding higher returns to offset rising risks. The yield gap between US treasuries and safer assets like German bonds is growing fast. Morgan Stanley's Vishwanath Tirupattur says the genie is out of the bottle. Once trust is broken, it's hard to restore. Global asset managers are already reallocating. They're buying gold, moving money to European bonds, and cutting exposure to US markets. Even though there's no strong alternative to the dollar, confidence is eroding fast. And that's what makes this moment different. It's not just the numbers, it's the trust. And nothing weakens trust faster than attacking your own institutions. One of the clearest warning signs were Trump's renewed attacks on Federal Reserve Chair Jerome Powell. At a rally, Trump declared, "I know much more than he does about interest rates, believe me." That statement might get applause, but it spooked financial markets. The Fed's independence is a key pillar of global financial trust in the dollar. Trump's pressure on Powell, despite lacking the constitutional power to remove him, raises serious questions about political interference. Allianz GI's Ranjiv Mann said that if the Fed becomes politicized, it could permanently damage confidence in US monetary policy. And without a trusted Fed, foreign investors may no longer view the US as a safe place for their money. The result? Higher borrowing costs, more market volatility, and a weaker dollar. It's a domino effect, and the first domino is trust in the system itself. But even deeper than the Fed fight is a fundamental flaw in Trump's strategy. Trump has long argued that a weaker dollar would help bring manufacturing back to the US and shrink the trade deficit. His team even floated a modern-day Mar-a-Lago Accord, echoing the Plaza Accord of 1985, where major economies agreed to depreciate the dollar. But here's the catch. Trump's own policies may be strengthening the dollar instead. Chatham House's David Lubin explains that tariffs typically cause foreign currencies to weaken relative to the dollar. Meanwhile, Trump's push to extend tax cuts will likely boost growth and inflation, leading markets to expect higher interest rates. Higher rates attract foreign capital, which pushes the dollar up. So while Trump wants a weak dollar, his actions could be making it too strong. And a too strong dollar doesn't just hurt US exports. It can destabilize the entire global economy by choking off trade and raising debt burdens in weaker currencies. Let's also discuss the allies Trump is alienating and why it's accelerating global de-dollarization. Trust isn't just about interest rates or trade deals. It's the foundation of international cooperation. And in Trump's second term, that trust has taken a direct hit. As the conversation explains, Trump's tariff attacks on close allies like Canada and Mexico weren't just economic shocks, they were seen as personal betrayals. Canada's Prime Minister Mark Carney publicly declared that the US is no longer a reliable partner. That's not political rhetoric, that's a global economic warning sign. These moves broke both strategic trust, based on formal agreements, and moral trust, based on the belief in America's fairness and leadership. Even Trump's bizarre inclusion of penguin-inhabited islands in his tariff list raised doubts about the administration's competence. The result? Countries are now rethinking their economic ties and their reliance on the dollar. While the dollar remains dominant, cracks are forming, and other currencies are stepping in. Central banks in Asia and Europe are quietly shifting parts of their reserves into more stable and predictable alternatives. According to the East Asia Forum, currencies like the euro, Singapore dollar, South Korean won, and Australian dollar are slowly gaining traction. It's not a full replacement, but it's a significant diversification. As Barry Eichengreen notes, this trend started before Trump, but his erratic policies are accelerating it. These middle power currencies are backed by trusted institutions, rule of law governance, and relatively sound macroeconomic management. Qualities investors now question in the US. Meanwhile, China's yuan still isn't freely traded, and the euro lacks a unified capital market. But the pressure to move away from a single-point dollar dependency is growing. The diversification isn't dramatic, it's deliberate, calculated, and here to stay. But the risk of losing dollar dominance goes beyond money. It threatens American influence. For decades, the US has enjoyed what economists call an exorbitant privilege, the unique ability to borrow cheaply and run trade deficits because the world relies on its currency. But that privilege is built on trust, and Trump's economic unpredictability is shaking the pillars that support it. As per the media reports, Trump's trade war has triggered the worst bond market sell-off in decades. Long-dated treasuries, once seen as the safest assets in the world, are now flashing red. If global confidence in these instruments continues to drop, the US could face spiraling borrowing costs. This isn't just a technical problem, it's a geopolitical one. A weaker dollar erodes American soft power, making it harder to lead alliances, influence global decisions, or enforce sanctions. As global institutions shift toward multipolarity, the US risks losing not just its economic edge, but its voice. And back home, the economic pain is already hitting the average American. While all this may sound like a global finance issue, the effects are personal. A falling dollar means more expensive imports. Everything from groceries to electronics costs more. The Economic Times notes that US long-term bond yields have jumped to 5%, the highest in decades. This isn't abstract, it hits family budgets, stretches small businesses, and slows down housing and auto sales. JP Morgan now estimates a 60% chance of a recession by year-end, and consumer confidence is nearing record lows. 2/3 of America's vegetable imports come from Mexico, and 61% of oil comes from Canada, two nations targeted by Trump's tariffs. So while the dollar weakens, inflation surges. The American middle class, already squeezed, is facing the fallout of a financial strategy that's both erratic and self-inflicted. And globally, nations aren't waiting around to see how it ends. They're preparing. Across the globe, countries are reassessing their economic playbooks. Germany is issuing nearly 1 trillion euros in new government debt, offering investors a euro-denominated safe haven. EU officials are openly positioning the euro as a more stable alternative to the dollar, emphasizing rule of law, fiscal unity, and predictability. The Guardian reports that even traditional US allies are considering backup plans, strategies to reduce reliance on the dollar and insulate themselves from future volatility. Meanwhile, China is pushing forward with its own trade arrangements outside the dollar system, and BRICS nations are promoting local currency settlements. Experts from Chatham House and Stanford agree. While there's no immediate replacement for the dollar, the trend is clear. The global economy is inching toward a multi-currency world. Trump may not have destroyed the dollar's supremacy outright, but he may have irreversibly weakened its foundation. The dollar's dominance was never guaranteed. It was earned through decades of trust, stability, and leadership. Trump's second term has thrown all of that into question. As nations diversify and allies distance, one thing is clear: the world is watching closely. Will America rebuild that trust or let it slip away forever? Let us know what you think in the comments below. Thanks for watching, and we'll see you in the next one.